All right, risk on versus risk off. The purpose of this video is to kind of take a snapshot of where the market's at right now and how we see that shaking out. We put several new reports out recently, hopefully giving fairly solid hints about possibilities for what might be happening. All right, so the newsletter is the market right now. It's free. You can sign up. There's a lot of links below. What we're looking at here is, are we transitioning from risk on to risk off? And what do we need to do about it? What have we already done, and where do things stand? So stick with me here. This report just went out recently. I'm going to scroll down. There's a lot of good data in here, I think, if you take a look at it. Some issues with liquidity, tech credit spreads, and some other things. But let me just go down here real quick. I'm going to read with this. So April 2025, this is important to get some context of where we're at and what's happened. So April 2025, we saw a nice bottom. We got long. A few weeks after that, this whole melt up thing, it started making a lot more sense. Like, hey, there's an obvious push here at the nation state level, public sector, private sector, all the wheels pushing in the same direction. So the melt up starts brewing. We're long. That's the way it goes. Powell comes in late in the summer, and his jawboning is starting to suggest that, look, and with the Fed meetings, even though they were pausing, that trying to move from restrictive to neutral, and that was potentially just a first step and eventually getting towards into an actual easing mode. Market said, look, great, real rates a year from now are negative, money's cheap, we should take on more risk. Market started rising even more. Then he comes in with a little bit of a rug pull in October at the October meeting and says, hey, let's tap on the brakes. Then we see all of this nonsense about rate cuts, basically just trying to talk the media and so-called experts and others, trying to essentially talk rate cuts into reality. They get the pathetic December rate cut in the Santa rally. But here's very important. Coming out of there, we did see bullish action. We're seeing small caps and we're seeing core resources, which I've been emphasizing ad nauseum here recently. Those were starting to move up in a bullish manner late December into January. At that point, I'm looking for follow through. Never got it. So now the question is, where are we? We've been kind of whipsawed around, and how much does that have to do with simply going back to the Fed and the Treasury? A couple dynamics at play right now, and then I'll get into the charts. One, TGA. Green line down here, TGA being drained, that means money, essentially money being pumped into the economy, the real economy. This isn't QE, but this is the real economy. TGA draining down now, TGA being built up, tax season, whatever it is. Who cares? The bottom line is it's rising right now. Then we go down to reverse repo, another potential source of liquidity. It's there, but it's intermittent. It's not just a fire hose of just oozing liquidity constantly. That's very important, I think, for folks to remember. So let's first get into the charts here. The NASDAQ, here's the NASDAQ daily chart. I'm sorry, the QQQs. It's very obvious we kind of have like this box here, this rectangle, I guess you could call it now, and it's been stuck inside. I'm going to show you exactly where I switched to risk off last time. Exactly. And it's right here. We got this nice hammer here. This thing came up on huge volume. It was a Friday. There was a mad rush. All the stocks not all, but most of the stocks on the watch list and a lot of leading stocks, high energy stocks started rallying that Friday late. It was very impressive, actually. We get a little push through to the next week, and then we're hung out to dry here. We start getting a high volume. We start getting lower volume on the up days through that week. And then this candle here got me very, very concerned. This is exactly where, right here, I switched to risk off last time. I didn't see the follow through, and at the time, we also had more of a concern, in my view, about an AI rug pull colliding with Powell saying, wait a minute now, and the market shifting its perception of real rates a year out. I switched to risk off. Now, we got a little bit of a dive here, but it actually wasn't even all that much. Then we have the low volume rally through the whole Santa rally. Santa, yippee, yeah, futures are up. There's no volume backing it up, no accumulation. Start seeing more distribution. Then early in the year, we see a little more distribution, another bounce up, save the day, Santa rally, blah, blah, blah. Then early in January, start seeing a little bullish move here. And this is where small caps are really rocking, and stuff like space, rare earths, etc., uranium are moving. But we never see the follow through. Here's the Greenland's drama and all that. And then we get the pop up again, low volume. Look at this, low volume. And look at all of the other higher volume bars surrounding all these smaller green ones. Money flow on the daily is red right now. We'll switch it to the weekly here. And you can see that, the reality is this. Here's the weekly chart. That's on the 21 now. I could put the 10-week up as general vicinity similar. Money flow on the weekly for QQQ is just simply oozing out. We have a lot more higher volume down weeks than we have up weeks on higher volume. Many more, and money flow is oozing out on the weekly. If we go to other things like leading stocks, here's Google. This is Google on a daily chart. Pre-market, it's actually down below the 21-day. We've had 2 high volume down days in a row, coming off recent local highs and testing the 21-day. And now in the pre-market, it's set to open below that. So if you add it all up, and then we're looking at QQQ in particular on the daily being stuck in this little box here. Reality is this. There's a higher level of risk, in my personal opinion. I've already taken actions. I've been very clear about that in the newsletter. Newsletter is free, by the way, as of right now. I'm going to change it to a paid subscription in the not too distant future. But right now, the entire newsletter is free. Bottom line is this: higher element of risk for a multitude of reasons. In my personal opinion, for what I'm doing, is I'm not worried about what other people are doing. It's not my responsibility. But I'm willing to share what I'm doing. Higher element of risk is present, and I have taken more protective measures for sure. This also includes Bitcoin. That's a separate topic, but included. So I don't know about a crash. Here's the thing about corrections. We got this one here. And, if you're starting from up here, this is where I was. We already had some corrective action, which was concerning. Then we got the nice bounce up. The point about hedging and protecting is, to me, a big point is entry point. If you're seeing deterioration here, you don't know where it's going to end when it starts to happen. And that's where we're at right now. So we don't know if this is going to be a little modest correction here. We got a little ABC action here, and then we came up, again, as I explained, no volume on the bounce back. But here we are right now. We're clearly seeing some deterioration. We're below the 21 EMA daily, and we're seeing some deterioration. So is this going to end with a nice little ABC, boom, up, or is this going to develop into something bigger? We don't know. That's why protection and hedging are relevant and important at all times. In my personal opinion, this is not investment advice at all. Only sharing what exact way that I'm looking at it, risk on versus risk off. I don't know if at this precise moment we're in a full-fledged risk off. I would say I know this is frustrating because if people want a definitive answer, I would say we're kind of hovering, we're on that seesaw tilting back and forth. It could go either way. Something could snap back in, an intervention or whatever, job owning, to snap back into a more bullish structure. But as of right now, it could very easily tip down into a full-fledged correction, no doubt about it.